Get the latest news at the click of a button inside your car. The new Bloomberg Business app. Now featuring Apple CarPlay and Android Auto. Listen to all your favorite Bloomberg radio stations and podcasts, including Bloomberg Surveillance, plus the latest news all on your dashboard. It's free and easy to use. Just download the Bloomberg Business app on your smartphone and connect the phone to your car. The Bloomberg Business app, now with Apple CarPlay and Android Auto features. Download it free in the Apple Store or on Google Play. Presented by our sponsor, Interactive Brokers. This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Jon Ferro and Lisa Abramowicz. Join us each day for insight from the best in economics, geopolitics, finance, and investment. Subscribe to Bloomberg Surveillance on Demand on Apple, Spotify, and anywhere you get your podcasts. And always on Bloomberg.com, the Bloomberg Terminal, and the Bloomberg Business app.
Is the Fed done? Is this basically what we're looking at right now? The all-clear sign for the Federal Reserve to have to do more. Jay Bryson, Chief Economist at Wells Fargo, joining us now. I ask that to you, Jay. Does this sound the all-clear for the Fed?
It does for right now, Lisa. I mean, these numbers are going to bounce around on a month-by-month basis. I wouldn't. Our view is that the Fed probably is done, but I don't expect Fed officials to be coming out just because of this one report saying, "Oh, it's all clear, everything's great out there." I mean, I think they're still going to continue to be biased to potentially tightening. We don't think that will happen, but if in the next few months these numbers kind of reverse and they kind of pop up and the economy expands at a stronger than expected rate, you could potentially see them going. But again, I think that's a high bar at this point.
This adds to signs that there is some sort of cooling, and this is the reason why so many people are talking about a soft landing, because you haven't seen the real cracks you'd expect ahead of a massive recession. Jay, do you think that that is an accurate categorization of exactly what we're seeing with prices not going up as much as people had expected?
Yeah, I think that's right. If we were still clipping along at a year-over-year rate on the core of a 5%, we'd be talking about the Fed hiking even more. And when you start to hike even more, that's when you have the problems. So the potential for a soft landing is still there. I guess what I'm a little bit still watching and concerned about is that the real Fed funds rate, the nominal rate minus some sort of inflation rate, continues to drift higher. And that's what matters for the real economy. And so I think the Fed's going to delay easing at this point. And so we may or may not have a downturn early next year, but I think the next few quarters, because monetary policy is going to remain restrictive, I think you're looking at headwinds on economic growth.
Is it mission accomplished? There's a comedy to that, a painful comedy for our geopolitics, our history, Dr. Bryson. But are we getting to a transitory point where this Federal Reserve can say mission accomplished?
Well, again, Tom, I don't think they're going to come out and say that right at this point. But, what I would say is the bar for further rate hikes is getting higher and higher at this point. Many of the members on the FOMC think they have done enough at this point. And, today's rally in the 10-year notwithstanding, we still have seen, relatively high long-term rates. And so there's a fair amount of headwinds on the economy right now. Again, they're not going to come out and say mission accomplished right now. They need to see a few more months of this before I think they feel confident in that. This is certainly a good start in that journey, but I still think you need to see a few more months of 0.2s before they say mission accomplished.
Lisa, the mission accomplished December 12th, a CPI report before a December 13th Fed meeting.
And just to really echo what Jay was talking about, that the bar is getting higher and higher for them to go again. Evidently, the bar is getting a bit lower for them to cut rates. Fed-dated swaps are now pricing in the first 25 basis point cut for June versus July before we got this print. Jay, there is this issue of what we're going back to. Are we seeing a fast enough pace of disinflation to believe that 2% is very much in the horizon? You and your team have been excellent about the last mile of getting inflation down from 3% to 2%. How far along that process are we?
So, if I don't have the numbers here in front of me, Lisa, but, I think if you look at the 3-month annualized change in the core, we're probably at 3.5% right now. So if you want to get back down to 2, what you need is a few months of 0.2s and even 0.1s to kind of get you there. And I think we're still looking at a number of months for that. We don't think we're going to be looking at that sort of number until the second half of 2024. But I don't know if we necessarily need to be 2% annualized for a few months before the Fed cuts. They're going to be looking forward, right? And if they are confident that things are really going to slow down, then they could start to cut rates, maybe summer or so of next year.
Dr. Bryson, thank you so much. The chief economist of Wells Fargo, Jay Bryson. David Kelly will adjust. He's chief global strategist at JPMorgan Asset Management. With his years at Putnam, knows when the facts change, he will change. David Kelly, how does your analysis change with this shock report?
Yeah, so this report is actually very close to what we're looking for here. As we're tracing out inflation, we can see it coming right down to below 2% on the consumption deflator by the fourth quarter of next year. And I think what's really important about this report is there's a large camp of people who say that the last mile is sticky. Getting from 3 to 2 is sticky. And we don't see that at all. We're going to step down inflation all the way through the fourth quarter of next year. And what I think this report is showing is across the board, there's disinflation in the U.S. economy, and we're heading back to 2%. And I think that is gradually changing the minds of the markets. And I think that's why you're seeing this move here.
Although it's not necessarily coming with pain, David, and this goes to the soft landing nirvana that Neil Dutta was talking about, that real average hourly earnings increased by 0.8%, up from 0.5%. People's earnings are exceeding the pace of inflation in a material way for the first time in a long time. How much does that lead to a stickiness because people have the means to keep paying the prices?
I don't think so, because we've had periods of positive real wage growth before. But what I'm seeing looking at the earnings reports from the last quarter is companies are very focused on holding earnings in check. Now, yes, you can say that today's earnings are higher than inflation, but from a worker's perspective, they're not even getting catch up from all the inflation they saw over the last 2 years. So what you're seeing is partial compensation for previous inflation. But I don't see a lot of evidence that companies are being able to push higher prices, the workers being able to push higher wages. So overall, I think what we're not seeing a price wage spiral. We're seeing a price wage slinky. They're both gradually coming down the stairs slowly. I think this is just going to continue all the way to 2%.
And there's a question mark around, yes, this is definitely good for bonds, and you're seeing that rally in a massive way today. Is this necessarily good for stocks over the longer term if it is accompanied with a cooling in the economy?
Yeah, I think it is. Now there are things that could go wrong, and there's certainly parts of the stock market that are overpriced. But I think what's happening is we're returning to where we were 10 years ago. We're returning to an economy with 2% inflation, very slow growth. That low inflation can allow for lower long-term interest rates, which supports all asset prices, bonds and stocks alike. And of course, stocks are the ultimate long-duration asset. So they will benefit from this lower rate environment. So, soft landings never last forever. They'll eventually be bumping the road and we'll fall into recession. But for right now, this does really show that inflation is steadily coming down, and we've got to recognize that's going on, regardless of Fed officials who occasionally say that we're not there yet or too early to declare victory. Look, I'm willing to say we're going to win this thing. It looks very, very likely that we're going to win this, get inflation down to 2% by the end of next year.
Small stocks, Russell up 4%, NASDAQ up 1.8%, though NASDAQ 100, I should say. Dow lags up 1.1%. Standard & Poor's 500 up 50, up 55, up 60, and now up 63 points, 1.5%. Dr. Kelly, I want to sum this up to the angst that Lisa Abramowicz has on our nation's debt. If we get inflation down, if we have a successful Fed, does that give you confidence that we can have a long-term R minus G relationship, R minus G equation that will mean our debt and deficit is of less fear?
A little bit. I mean, it's still, what you're basically saying is we can service this debt at cheaper prices, no matter how large it is. Yes, we can to an extent, but I think the amount of debt we've piled up in recent years is going to mean permanently higher long-term interest rates than we experienced 10 years ago. So that problem is going to be around for a while. And unfortunately, I see no evidence that there's any consensus in Washington about doing anything about it. So I'm still worried about populism on the left or the right just pushing these deficits higher and higher in the years ahead.
Dr. Kelly, thank you so much. David Kelly, JPMorgan. Joining us on applied mathematics of big box retail, Elizabeth Suzuki joins us at Bank of America Securities. When you were going through polynomials and doing Ferris proof and all that in applied math, you think you'd be in aisle 4 at Home Depot?
I did not. I never thought that my work was going to include channel checks at stores that I just go to anyway. In fact, now as a homeowner for the last 6 years, I'm in Home Depot pretty much every weekend, maybe every other weekend, but I mean, it just never stops.
Wonderful. I've never been to the one downstairs. Farrell's down there once a week picking up something. Let me cut to the chase, which is the new post-pandemic Home Depot world, and for other big box as well. Can they fix the problem on the income statement? Mm-hmm. Can they take out expenses like Disney or you name the bank?
Sure. I wouldn't really categorize it as a problem on the income statement. When we think about what Home Depot is going to do this year in terms of sales, they're probably going to end up about 50% higher than they were in 2019. And just putting that in context of the broader industry, which is tracking up about 20% versus 2019 levels, that's an amazing amount of market share that Home Depot's been able to take. I mean, we're coming down off of these very, very high levels of spend during the pandemic. Homeowners had, easy rates to be able to borrow against. They also had, stimulus money to spend. They were moving at much higher frequency. A lot of people moved out to the suburbs during the pandemic. I mean, we've seen a slowdown in that. And, I think what's been surprising this year to the downside and just where we've seen that pressure on the top line is really mostly from housing turnover basically coming to a standstill. So as we expect,
really?
So I think, as rates start to moderate or potentially even come down, maybe towards the second half of next year, I think that's going to help spur that housing turnover again. And we're going to see more of a return to normalization in terms of that top line sales growth.
Given where mortgage rates are, do you really think we can normalise the fact that there are some people just locked in their homes with a 2-3% mortgage who just aren't moving anytime soon?
Yeah, I think it's once rates really stabilize, maybe come down a tick, a couple of rate cuts potentially in the second half of next year, then, the homeowner is saying, okay, rates are probably not continuing to go up. I can potentially refinance if I were to, move today. I'm locking in a rate that's higher than what I wanted, but I feel like there's some potential for that to come down over time. And maybe it means that people buy a house that's a little bit smaller than what they wanted, or it means that, some people who are moving and are going to have to absorb a higher rate. But because households have such high levels of savings, they actually can absorb that. It's just, it is uncomfortable, right? So right now we're feeling that discomfort in terms of existing home sales, which are the lowest they've been in 13 years.
How much does Home Depot rely on the housing market versus the fact that if people aren't moving, they are buying new refrigerators, I'm just saying, or they're buying new stoves or new microwaves or other items in the house that might break? I mean, at a certain point, does that actually help these companies?
Yeah, I mean, the sector is not as sensitive to housing turnover as one might think. I mean, when you're seeing these, negative data points on housing every day, and if you already have sort of a negative bias, each one of those data points just kind of confirms your bias, and you're going to say, of course, things are terrible right now. So what we've done is we've tried to look at basically every macro factor you possibly could, and this is really where, that applied mathematics comes into play, is we built a proprietary indicator of home improvement demand. And we narrowed it down to 14 different factors that are reported monthly that we can correlate to Home Depot and Lowe's same-store sales growth. Because at the end of the day, that's pretty much what drives these stocks, is same-store sales growth. So we narrowed it down to these 14 factors. We built an indicator off of it, and then that indicator helps inform our views where we don't have to be dependent on the company's guidance. We don't have to be dependent on third-party forecasts. We're able to actually look at the factors that matter, and then month to month, we can track each of those factors and not get distracted by the the noise that we hear in a lot of these other data points.
How correlated is Home Depot to some of the other retailers that are not related to the housing or home improvement sector?
Yeah, I mean, that's a really interesting question. And I think, when we boil it down and look at the broader sector and look at Bank of America's credit card data for the home improvement retailers, which is, just very broad category, Home Depot has outperformed that group pretty consistently, actually very consistently over time. And Lowe's has as well by at least 200 basis points. So, the market share gains here are pretty material. And that's something that I want to just continue to kind of hone in on in this result is even though their sales are down 3%, we've seen the category down, mid to high single digits year over year for most of this year. But in terms of correlation to, to other retailers, it's pretty independent. I mean, it's some factor of the broader consumer and the health there. And so obviously there's correlation to like a Walmart and a Target. But because it is related to housing and really home prices are one of the most important factors driving home improvement demand, that's really where it kind of differentiates.
We've all been surprised by the strength of this economy this year. There's a bunch of companies that fall under your coverage. We're trying to work out whether we are at the precipice just around the corner from a severe weakening of the economy. Do you see any of that emerging whatsoever going into year end?
Yeah, I mean, I think that there are categories that we follow that are struggling more than others. Appliances, we talked about refrigerators. I mean, appliance sales are down. The volumes have been under pressure. Margins are coming under pressure as well. We saw promotions that started in October for appliances. So you should get on it if you're in the market for a fridge, because I think those promotions are going to be, pretty attractive this year.
You need the camera on Grandma. She looks so happy. You're so impressed with yourself.
Please go on.
What kind of discount did you get?
No, I just want to hear what you have to say. Carry on.
But consumer electronics is another one, right? I mean, as Home Depot said in their press release, they're seeing pressure on big ticket consumer discretionary products. So consumer electronics, definitely one of those. Appliances kind of fit in that bucket as well.
Ken from New York University just emailed in. So you're sitting here with Ken Langone. He's going to go, this is all a lot of great chat. But the bottom line after 3 years pandemic malaise, let's call it, is can they get back on track to the total return that we were weaned on? Can they get back to 16, 18, 20% per year share return?
Yes, I think, in this current macro environment, that's tough, because the consumer is pulling back on spending and we are coming off of this, sugar high from the last couple of years. But, as we look to 2024 and 2025, we see no reason why there shouldn't still be growth in the home improvement sector beyond the broader economy.
Liz, this was great.
Thank you.
It's good to see you in person as well. Greg Valliere joins us right now, the Chief US Policy Strategist at AGF Investments. Greg, in your mind, from your perspective, in your opinion, do you think this can get through Congress this week?
I think they can. It's been so humiliating for them for the last few weeks. I think they know they've got to do something. The credit rating downgrade is serious. So, yeah, I'm at 60-40. I mean, it's possible that a handful of far-right radical Republicans could kill this. But I think they want to give, at least on this first bill, they want to give Mike Johnson a victory.
This is what I was going to ask, Greg. Who does this particular offer upset more? Is it Republicans within his own party or elsewhere?
Well, it's a good point, John. There's so much in the bill to hate. For the conservative Republicans, there are no spending cuts, and they're quite upset over that. For the White House and the Democrats, the fact that there's nothing for Israel or Ukraine is very troubling. And we can say, we'll get them some money in February. Well, they need money now, and I think to not send our allies this money sends a very bad signal.
Greg, it's that time of year. Our Greg Giroux owns a high ground and keeping track of who's leaving, who's coming, who's going in the House, in the Senate. Juan Williams in the Hill today, or yesterday I should say, really writes it up of the Republicans leaving the House. I think this is underreported. You've got Buck, you've got Granger, you've got Lesko, you've got Spartz, on and on. Is this going to be even a more Trump Republican Party, not in a year, but in a matter of weeks?
It could be, yes. And a lot of the names you mentioned are people who are disgusted. They can't take it anymore. I also think there's a growing chance, a very good chance, that the next Senate will elect a year from now will be controlled by the Republicans. They have, I think, an easy chance to take the Senate.
I look at this as wildly underreported. The focus on Manchin and that in Spanberger, Virginia. Have you seen it like this before? Is this normal changing of the chairs, musical chairs, or is there something unique here?
Well, I tell you, Tom, I think what is unusual is to have Democrats talking now openly about a need to get a different nominee. That's really unprecedented. You probably have to go back to LBJ, who lost support in his own party. That makes the Democrats nervous, the fact that they could lose the Senate and lose it convincingly.
We'll get back to that in 1 second because I do want to get your view on that. But just to build on what you're talking about, the fact that Democrats are joining with Republicans, some of them, to back Mike Johnson's plan. Isn't this what got Kevin McCarthy ousted as House Speaker?
Bingo. That's right. And I got to think that we could have a repeat. You only need like 3 or 4, at the most 5 no votes, and this whole thing could fall apart. So I think that Johnson has to worry that he could suffer the exact same fate as Kevin McCarthy.
And there still are at least 9 ultra-conservatives in his party who are going to vote against this, at least as for now. What's worse, though, on an international stage? You were talking about no funding for Ukraine and Israel. Is that worse than a government shutdown in the U.S.?
I think a government shutdown is become so ordinary. A brief shutdown wouldn't be as serious as sending a signal to our allies that we can't support them. I mean, this, I think, is really very, very unnerving. One other point I'd make quickly. I do think the final outcome is Johnson having to cut a deal with Democrats. I think that's the only way we're going to get a deal in the next week or two, is to have the two parties unite on this.
What will be the ramifications of that? I call that doing a John Boehner for our international audience. We've seen this before. But then what is the outcome if he does that?
The outcome is going to be an effort to oust him. I still think it's less than 50-50. I think they want to give him a victory, Tom, but you could see a lot of Republicans say this is totally unacceptable.
Greg, let's talk about the race for the presidency next year. The field is narrowing on the Republican side, and it looks like Nikki Haley's starting to attract some money. What do you make of the moves we've seen in the past week, Greg?
Well, Tim Scott didn't surprise me in the least. I think that the strongest, other than Trump, of course, has been Nikki Haley over the last few weeks. She's got real momentum. DeSantis does not. He didn't even mention his endorsement in Iowa from the governor. I can't figure
Greg,
out.
That was so weird. Can I just jump in? What was that about?
Yeah.
Why didn't that come up in the debate?
I don't get it. She endorsed him. I'd be bragging about it, but he didn't even bring it up in the debate. That was mystifying. But it's still Trump's to lose. Trump has said some extraordinary things in the last few days about how his opponents are vermin, using really, even by his standards, exceptionally harsh language. But his numbers hold up. He still has the base.
And that means we need to narrow the field potentially even more for the Republicans. Who's next to drop out, Greg?
Maybe Ramaswamy. He's got money, but I could see him drop out. He's got no traction. His numbers don't look good. I think DeSantis and Nikki Haley stay in, and probably Chris Christie stays in, and that's good theater.
Well, at this point, maybe the field is narrowing on the Republican side, but in some ways it's actually widening on the Democratic side. You said that there's real fear and there are real calls within the Democratic Party to have some other options than President Biden. How realistic is that? Who is everyone coalescing around?
Well, that's the problem. Nobody. And I think one of the strongest things that Biden has is the lack of any clear successor. And I think because of that, he will be the nominee. Apparently, in the last 24 hours, he's been very angry, profane, criticizing people like David Axelrod. I think he feels that he should be the nominee. I think he will be the nominee.
What do you think he's upset about, Greg?
Oh, mocking him for his age, probably more than anything else. He can't do much about that.
That's true. Greg Valliere of AGF Investments. Don't think any of us can do anything about that, Greg. Appreciate the update, sir.
Subscribe to the Bloomberg Surveillance Podcast on Apple, Spotify, and anywhere else you get your podcasts. Listen live every weekday starting at 7 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can watch us live on Bloomberg Television and always on the Bloomberg Terminal. Thanks for listening. I'm Tom Keene, and this is Bloomberg.